excited to be able to have Bruce Bender join us this morning. Bruce recently did a live workshop in Baton Rouge at the Greater Baton Rouge Board and provided some information with regard to flood insurance. He is a community engagement and outreach services kind of flood insurance expert. He has been supporting FEMA's NFIP national marketing programs and national mapping programs. He helps communities with community engagement and outreach efforts, and he's participated in numerous flood insurance related research studies. He has been an expert witness in court cases related to flood and private flood insurance. So thank you, Bruce, for taking time out of your morning to present some of this information for us. I know it's always a hot topic for realtors and with their clients and kind of going through some of the things. So with that, I'll let you take it away.
Great. Thanks so much, Amy. And thank you, everybody, for taking time out of your schedule. I know, the buying and selling of homes and commercial buildings and the like, it's a full-time job, night and day. So thank you for squeezing in some time, and for anybody who happens to be listening to the recording as well. That workshop that Amy just mentioned in this webinar is part of an effort of the Louisiana DOTD to promote people's understanding of flood risk as well as flood insurance. They got a grant from FEMA to help people better understand about flood risk and flood insurance in Louisiana, and hopefully increase the number of people protected financially with flood insurance and or taking other actions to reduce that flood risk. So that's behind. I was asked to help out with Louisiana DOTD, who is also a cooperating technical partner with FEMA in helping with the mapping effort, remapping effort of Louisiana, which we'll talk about a little bit. So what are we going to talk about? A lot of people try to guess what the name storm is on the picture you see there. It actually is your storm from 3 years ago, August, when we gave the workshops. It was the 3-year anniversary that week. And of course, we're well aware of what Dorian is doing as it slowly crawls up the East Coast after giving incredible devastation, unfortunately, to the Bahamas. And we hope that doesn't happen here, but we know it does flood. And so we want to kind of arm realtors with some basic facts about flood insurance. So when they do talk to their clients, they're more informed or well informed. So we'll cover a couple of those basics here in the next hour. I do want to touch upon map changes. We do have 22 different projects going, believe it or not, going on in the state. So your area may, at some time, if it hasn't already been affected by map change. What we're seeing an increase on is the number of flood policies being written in the private market, as well as you all have heard probably already, or some of you, about how the NFIP is taking flood insurance in a new direction starting next year, called Risk Ready 2.0. So I'll touch upon those two, and then I'll provide some resources at the end. I did speak with Austin Perez of the National Association of Realtors to help get some direction on points and whatever, as well as based on feedback I got from the workshop a couple weeks ago. We will stop for some questions along the way. If we get too many, I will hold them off to the end so I can make sure I get through this in an hour's time. So let's jump right into the basics of flood insurance. And a lot of people wonder about, like, what is a flood? So we wanted to make sure everybody, I try to, at least in these workshops, know what a flood is, because it's very specific. And as opposed to the cartoon, that's not exactly as it says how they define a flood. It's a single peril. That's it. That's all the policy covers. Why? Because most homeowners don't cover flood insurance. It's got to be general and temporary. And here's the key. In the rural areas, it's 2 or more acres. In the more urban area, it's 2 or more properties. Now, it says one of them has to be yours. I don't know why it says that in the policy, but it does. You would be making a claim on your neighbor's house, but maybe you would. and it's from unusual and rapid accumulation of runoff or surface from any source. So when that person unfortunately drops their phone and they reach down to get it and they lose control of the car and they hit the fire hydrant and it explodes and water floods the street and water floods your house, etc., that can count as a flood because it's from any source. Now, we don't have mud flows, but as you know, out in California and Arizona and other areas where we have the wildfires, mud flows follow quite often, also in places like Puerto Rico. So take a look at that definition again. 2 or more properties, flooding from any source. Keep that in mind because I'm going to show this picture here. This is a picture of a park. It's actually a park there that's flooded, and the house next door is flooded. So the question is that a flood by NFIP definition? Because it's only the house that's flooded. But in reality, it is because it's 2 or more properties. It does not say 2 or more buildings. And the park is owned by the city or town. And the house, of course, an individual. So this could count as a flood because 2 or more properties are flooded. So how much coverage can you get through the NFIP? Now, there is private flood. You can get excess on top of this, additional coverage. But for your homes, it's $250,000. And for other residential, like apartments and non-residential, your commercial structures, houses of worship, etc., you got $500,000. Contents, $100,000 for the homes, $100,000 for the other residential, and then $500,000 for your commercial. Also, you have condos in there. We don't cover those, but your residential condo association buildings can get $250,000 times the number of units for coverage. Pretty good coverage for those condos. So what can be insured? Well, with I actually saw a site put up by a realtor of some of the unusual things that you have to try to sell, like upside down doors or very colorful bathrooms with lots of little icons all over the place, or somebody who put in an unusual swimming pool in their house. So while you have a lot of unusual things to sell, from a building perspective, the NFIP, as long as it has 2 walls and a roof, it's covered. It will write manufactured homes, your mobile homes, and even buildings in the course of construction. So if you are helping close on a property where they will be beginning to build from scratch, and they have to get a loan because it might be in a high-risk area, you can get buildings in course of construction. Unfortunately for you all that sell commercial, buy and sell commercial real estate, there is no blanket coverage. That means on your commercial property and casualty policy, quite often you can put all of the buildings on one policy that are in an area. Let's say a university, let's say agricultural buildings. But in the NFIP world, every building has to have its own policy. So an important part of the policy coverage is garages can be covered under the dwelling form up to 10%. Now, it can't go over the total 250, but they'll take it from whatever limit the building you have set. So let's say I have this garage there in the right-hand corner, and it could be included in the coverage of that house. But if it's used for anything other than as a garage, like grandmother's house, farming purposes, you've got a hobby or business in there, it has to have its own separate policy. But here's the thing that's unique. The mandatory purchase rules changed recently. And if that garage is in Zone A and the house is in Zone X, the mandatory purchase requirement does not apply, which means that homeowner could get what's called a preferred risk policy very inexpensively to cover and include that garage because it is part of the dwelling form. So the rule is somewhat new. So if a garage is in a high-risk area and the home is in a low-risk area, the mandatory purchase rule does not apply to your client, and they can get that cheaper preferred risk policy if it qualifies for it. So a new rule to keep in mind. Usually that happens when there's a slight slope and the garage is downhill a little bit, closer to the creek or whatever flooding source is down there. What's not covered? A couple of things to point out. The building, if it's over water, if it's been sanctioned, called a Section 1316, which is basically FEMA has asked the building owner, or the community has asked the building owner to take some mitigation actions, and it refuses to, the owner does, they can Section 1316 say you can't get flood insurance. But the key things are at the bottom. Your land, walks, driveways, swimming pools, hot tubs outside are not covered. So basically just the building. So I'm going to put up two risks here, a silo on the left and a gazebo on the right. So think about in your mind in the definition of a building, are both of these covered? Well, if you said the one on the left is, you're correct, because I believe it has a wall and a roof. But on the one on the right, it does have the roof but has no wall, so the gazebo would not be covered by the NFIP. An interesting coverage that is included is increased cost of compliance. It's kind of like your homeowners, many have this, increased cost of construction. So if the house burns or what have you, and now the wiring has to be upgraded, or the plumbing has to be upgraded because they don't allow that type of wiring and plumbing, and your policy has that coverage, that would be automatically included. Well, here it applies if there's a floodplain ordinance that has changed since the time your house was built. For example, a map change has occurred. The base flood elevation where you're supposed to build to has increased. Now you have to build at that higher level, which means you have to elevate up to $30,000. You can get this increased cost of coverage. It has to be in a high-risk area, zone A or V, and it has to be substantially damaged, which means 50% or more, or repetitively flood loss, which 2 losses in 10 years of 50% or more. So it applies to, you can use that up to $30,000 for, and I have an acronym there, FRED, flood-proofing your commercial structures only, relocating it, elevating it, or demolishing it. So it can go towards there. Now, it can't go over, it's still part of that $250,000 maximum. But here's the key thing to know. Communities after disasters often get grants from the federal government, and they can use your $30,000 to help get additional funding, because unfortunately, to elevate a house, and it's a little extreme to the right there, this happens to be near a levee, it does leverage that money and allow you to get that additional money to elevate to that higher cost. So I wanted to just highlight, and Austin Perez wanted me to highlight the importance of taking mitigation actions to reduce that flood risk. And one way is after a flood is using the ICC coverage. So another point to bring up that realtors need to understand, because how it can affect the insurance rates of their client's building, is when the building was constructed and or substantially improved. There's a term called pre-firm. Firm is flood insurance rate map. And if it was built before basically the community joined the NFIP, it has been getting what are, and it's in a high risk area, it's been getting what are known as subsidized rates. Subsidized not by taxpayers, but by actually other policyholders paying a little more. So these people could get these subsidized rates. Why are they? Because Congress felt back in 1968 when they created the program that these people did not know not to build where they are because they didn't have flood maps. So, okay, we'll give them a subsidized rates because eventually those buildings will probably be torn down, updated, et cetera. Well, about 20% or probably a little less now of the building stock or buildings covered by the NFIP are still pre-firm and still getting subsidized. And these are ones that Congress said we want to reduce that subsidization and get them closer to full risk or actuarial. And that's what post-firm rates are. Post-firm means the first home, it's been built on or after that first flood map. And so therefore it had to comply with local ordinances, because the community, when they joined the NFIP, said we are going to build according to what the flood map says or higher. And that means Well, if you're in a high-risk area, you're going to have to get an elevation certificate, which we'll talk about in a minute. But there are full risk rates, they're actuarial rates. And that's where Congress wants this program to get to, is the buildings to become all full risk rated. Well, how does that affect you guys? Oh, here's an example. So if the city of Abbeville there in Louisiana got its first flood map in August of 1982, and the house you're trying to sell was built in 1981, a year earlier, is that pre or post firm? Well, if you said pre-firm, you're absolutely correct, and so it would be getting subsidized rates. Now, keep in mind, these subsidized rated buildings could always be rated using elevation certificates, and we find sometimes they get actually a cheaper rate by using that elevation certificate. But here's how it can affect you all in the realtor world. Now, if a primary resident, which means they live in it 50% of the time or more, in those older homes in high-risk areas, their rates will go up like other rates. They'll have to go up, though, at least 5% a year, according to Congress. But if it's not their primary structure, it will increase 25% a year until it reaches full risk rate. Now, I'll hit what full risk rate is in a minute. So let me give you an example. Let's say this home in this picture, the current homeowner, it's their primary residence. Your client comes in and buys it and says, we're going to use it as a vacation home, or we're going to use it as a rental home. You've just changed it from a primary to a non-primary residence. And if it was this older home built before the first flood map in the area, in a high-risk area, suddenly their insurance would go up significantly. So that's why it's important you understand what the occupancy will be, how will it be used, and is it pre-firm or post-firm? So the question is, okay, Bruce, how do you increase it at 25% a year until full risk rate? What is FEMA going to tell me that? Well, no, actually the homeowner has to get an elevation certificate, and they have to determine with the insurance agent then when it does reach full risk rate. Each house is different. So if the house have to be built close to the base flood elevation, it may not take that long to get there at 25% a year. But if it's actually the elevation certificate shows it's 4 feet lower than what it's supposed to be built at, it could take some longer. But here's an important thing. Legislation had kind of taken this away, but it did come back. The policy and rate can be transferred at the time of the sale. And I'll keep emphasizing that because it also is important in other areas. So again, how the building is used, if it's pre-firm, can result in significant rate increases. Likewise, the other area that Congress hit was, if you look at the bottom bullet, businesses, those commercial structures, pre-firm, built in high-risk areas, will be seeing a 25% increase until they get to full risk rate. So keep that in mind. What flood zone, how it's being used, and when was it built compared to the first flood map. Speaking of zones, it's important to know those zones. We have what are called the special flood hazard areas, and some people say to me, Bruce, well, why is it so special? Because I have to get flood insurance. But they're known as the high risk areas. On the flood map, zone A or zone V. V is in velocity. That's right along the coast. You'll hear the term 1% annual chance. You also hear the term 100-year flood, and we're not too crazy about that because people think, well, we had the floods in 2016. That means I got 97 more years before that big one comes again. We know Mother Nature's not following that rule too well these years. If you translate that 1% annual chance to the typical 30-year mortgage that a lot of your homeowners are getting, that's a 1 in 4 chance that area will get hit in the next 30 years. It does provide the base flood elevation that I was just talking about. You'll see one circled there on the red on the screen. And in the high-risk area, the mandatory purchase requirements kick in. Now, that mandatory purchase requirement is not something that FEMA enforces. It is the lenders and the lending regulators. And basically it says, if you have a loan, if you're making, increasing, renewing, or extending a loan, the lender has to check to see if it's in a high-risk area. And if it is, then it has to make sure flood insurance is enforced and enforced for the life of that loan. A good acronym to remember is MIRE, like MIRE down in federal regulations, however you want to remember it: making, increasing, renewing, or extending. Now, I have there a newish escrow requirement. A while back, it used to be that if you escrow your homeowner's insurance or taxes, you'd have to also escrow flood insurance. Now the new rule says flood insurance has to be escrowed all of the time. And then the bottom bullet, the appurtenant structure exception, that's the one I mentioned earlier. If the garage is in the high-risk area and the house is not, no longer, and they're both on the same loan, no longer are you federally required to carry flood insurance, though the lender always has the option at any time to require flood insurance. So how much is required? Well, it's one of three, the outstanding loan balance, but it can't be more than the maximum available in the case of a home, $250,000, and it can't be more than the insurable value of the building. Now, I say building because it's not the property and the land. So you may have a loan that's for $300,000, but the house may only be worth $100,000 because the property is so valuable. Therefore, it can't be any more than the $100,000 of the building. If you fail to get flood insurance, or your client forgets to get it or doesn't renew it, then they will force place it. They'll send out a letter. They'll send out one about 30 days or right at the start saying, hey, we see you don't have flood insurance and we need to make sure you do because you're in a high-risk area. Send us evidence. And then 30 days later, they send another letter saying, hey, we see that you haven't sent us that yet. And if they're like me, I'll put it aside saying I'll get to it. So I need that second reminder. And if you don't, in 15 days, we're going to send you a third letter, which will have your forced place policy, which can be anywhere from 3 to 8 to 10 times more expensive than the NFIP policy. Why? Because they don't underwrite it. You're in an A zone, you're in a B zone, here's the rate, boom, done. So definitely want to make sure everybody has coverage and not use the forced place. Continuing on knowing about the zone, you've got those high-risk areas. Well, you've got the moderate and low-risk areas known as non-special flood hazard areas, but they're not no-risk areas, and that's kind of a downside of using that term non-special flood hazard area. The moderate-risk areas are the one, if you look at the flood map there in the lower left-hand corner, the black stipple, the black stipple there and about in the top center, those are shaded zone X. Those are the 0.2% annual chance. In Louisiana, what we find in these areas and then in the low risk areas, but in these non-special flood hazard areas, about 25% of the claims are happening. And these are on properties that had flood insurance. So think about all of those, just like your 2016 flood, that did not have coverage, or like in Harvey, that did not have coverage. The cool thing is, and sorry, in the non-shaded area there, kind of in the center of the map, is your low risk. But again, it's not a no-risk area, especially in Louisiana. We all kind of live in a flood zone. So if anyone ever says, hey, I'm not in a flood zone, that's not true. It's the level of risk that may be different, but we are all at some risk of flooding. The beauty of this is the NFIP came up with a policy several years ago called the preferred risk policy. And it probably is better known as a preferred rate policy, but where it combines building and contents, just like your homeowners. And this is the only time they are combined. When you buy flood insurance, you've got to buy buildings separately and contents separately. They'll show up on the same policy, but you have to ask for both, except in the PRP. It's available for commercial and residential structures. B, C, or X, those low risk zones, they also add recently the ability, if you're behind a levee in an A99 or AR flood zone, which are areas that are required to have flood insurance, they say this will apply as well. Again, limited claims, it's a special policy, it's preferred policy, just like if you've had no auto accidents and stuff, you get a really good rate. As soon as you have an accident, or if you have a teenager that turns 16, your rates go up, you no longer get the preferred rates. Same thing applies here. I mentioned earlier base flood elevations. Why is that important? I'll get to how it's used for rating, but that's where they're saying that base flood, that 1% annual chance flood will come to, like this house on the right. They built, notice that kind of first floor up high. probably because the base flood elevation was sent that was on the map showing it to be that high. So the lowest floor has to be at or above that base flood elevation. And for the lowest floor, it's the top of the slab or the top of the elevated floor in your zone A area. But in your zone V along the ocean, it's the bottom. Why? Because those waves are going to start eroding and attacking from the bottom typically first. But here's why I bring this up. The difference, the higher the lowest floor is above the base flood, that difference, the lower the risk, the lower the rate. But you're going to have to get an elevation certificate to identify what those two elevations are and some other aspects of the building. And this is for post-firm buildings, but also for those pre-firm buildings as well. So as a realtor, you're getting ready to close, you find out it has to have flood insurance, it's in a high-risk area, things will come to a halt if they have to go get that elevation certificate. I would ask, if you're buying the home, somebody's home, do they have that elevation certificate? Do they have flood insurance? Can we have you assign the policy to us as a new owner? Because that way there are many benefits. It makes it easier from a rating perspective or from a flood insurance perspective. You might even get the ability of having the savings with the rates that they're using, if it's been grandfathered, that we'll talk about in a little bit. If you have a client who is buying the land and going to be building on it, or if we have anybody who are developers or builders on the phone right now on this webinar, look at the savings that elevation can make. And again, OSPRES wanted me to emphasize this point. If you only build at base flood elevation, in this example, a $250,000 building, value building, be about $2,000. But just by going up 1 foot, you have a savings of almost half. And if you go up a second foot, another third savings there. So just by going a couple feet can make a significant difference. And if you're planning to be in the building several years, then that savings can be realized as you are building, if you're planning to be there and you're building from scratch. And then if you get damage, take a look at it as, hey, why don't I elevate 1 foot more? You know, with climate changing, weather conditions changing, the flood maps aren't updated, you know, as often as we would like them to be. We know the flood risk is going to increase. Why not build higher if you have that opportunity? So if you're talking to your clients who are building, let them know that there can be a savings, and to talk to their insurance agent to determine what those savings might be. One other place to help reduce the cost is a community rating system. I throw this out there as an FYI. A lot of communities in the state of Louisiana do participate in the community rating system. It's where they've raised their hand and said, not only do I want to join the NFIP, but I want to join the community rating system because I'm going to build above the standards and do things to help reduce the flood risk in my community. And then if you notice near the bottom, Jefferson Parish, they are a class 5 now, which means they're getting a 25% discount. The policyholders are in high risk areas in that parish. Discounts can go up to 45%. Finally, I wanted to just highlight a couple aspects of the policy basics. As opposed to your auto, which might be paid monthly, your homeowners might be paid monthly, or your 6-month auto policy, it's a 1-year policy for the NFIP, and it has to be paid with check, money order, credit card. Why? Because the NFIP needs to document the date to start the waiting period. And that waiting period is typically 30 days, but if there is a requirement by the lender, typically there's not a wait, though there's that changed slightly, but I'll just keep it at that for now. Map changes, which we'll talk about in a minute, is a 1-day waiting period, and post-wildfire conditions don't really have that issue here in Louisiana, but there is an exception there. But again, the point I want to make is to realtors, the policy of a existing policy of the homeowner can be transferred or assigned to the buyer. And this can result in significant cost savings. and could be a selling point. So even if the current owner doesn't, and you're selling that home for that current owner, doesn't have a policy, it might behoove them to go get a policy and have it in place so the new owner could get any benefit from that rate or rating option, which we'll talk about next in MAPS. So with that, Amy, let me stop and see if we have any questions.
Bruce, I don't see any questions coming in at this point.
Okay, great. Well, let me continue then. And so, and you'll see my contact information at the end. So if you don't want to ask a question now, but want to email me one, please feel free to, or I'll also give you the FEMA insurance specialist for Region 6, which you're in. His name, he's really knowledgeable and very responsive to questions. So I mentioned about the mapping. So let me talk about FEMA's mapping program, Risk Mapping, Assessment, and Planning, or known as Risk Map. There's a lot of projects going on in FEMA Region 6. There's 5 states in this region. They've got 176 projects going on. Of course, Texas is a big state. But in Louisiana in itself, we've got over 22 projects going right now. And we have some other ones that I did talk about in the workshop called base level engineering, but we don't have time to get into those. So a lot is happening in the state of Louisiana, and maps will be changing. Maps have changed. So it's important that as realtors, you stay on top of how the changes that are happening in your area that you are selling or buying will affect your client in the future. Are they becoming effective soon? Are they becoming effective in 2 years? Should my client be getting flood insurance so I can then assign that policy? Should I avoid being, or should I let my client know that this area, which is low risk right now, is going to be in high risk? So he or she may want to be aware of that before they buy. So let's take a look at the different things that can happen. Here you have a building that is in Zone X. And when the new maps come out, we now find it's in Zone A. So it's newly identified to be in a high-risk area. So that means the mandatory purchase requirement kicks in. It says, hey, you got to get flood insurance if you have a federally regulated or insured loan. So what they can do, the new owner, or the current owner, I should say, is purchase a policy before the maps change, and then they'll start at those low-cost preferred risk policy rates. If they get it within the 12 months of the map becoming effective, we encourage to do it beforehand, and then it will slowly increase until it gets to the full risk rate. So it's not going to zoom up to a Zone AE rate or what we call a standard Zone X rate, but over many years it will finally get there. But the important thing I want to point out here is by having that policy in place, when your client who owns this house sells it, the new owner can be assigned the policy and they can continue to have the benefit of this rating option. So the newly mapped procedure can be assigned to the new owner. If not, and they're past that 12-month time window, then the new owner may have to pay a full risk rate Zone AE, or possibly, we'll talk about next, grandfathered Zone X, which is going to be a lot higher than the stepping stones of the newly mapped procedure. So the bottom takeaway of this is you're newly in a Zone A, get a policy before the maps change, and then when you sell it, the new owner gets the benefit of that policy.
Hey, Bruce, there is a question regarding that.
Okay.
Do garage apartments that have separate policies get rated the same as a main home in Zone A, even if the elevation is 10 feet or more?
So If you have a house that has a garage that is also a dwelling, it will have to get its own separate dwelling policy, and then it will be rated as any other home or residential. If it's in a high-risk area, it'll have to get the elevation certificate, and then it will be rated the same as the other house. Now, if it was in a zone X, like in this example here, where it was in zone X, and let's say that's the garage that's actually a residential, and then we find it's in zone A, it too can go through this newly mapped procedure, and it too can start at a preferred risk policy and have the benefit of those slow rate increases. Did I answer that question, or whoever sent that in, if they need clarification, let me know. No.
You're okay for now. Go ahead.
Okay. All right. Thanks. So I mentioned grandfathering. So let's say you're already in a high-risk area, zone AE, and now the coastal near the coast, and now they, with the updated coastal flood maps, they show you're in a zone VE. Or let's say you are just in zone A, and the base flood elevation has increased. So the risk has increased in all these cases. The benefit that the NFIP program has is a thing called grandfathering. And there are two types, and I don't want to get into the details, but one is the first one is we encourage everybody. Get a policy in place before the maps change and just maintain coverage. If for some reason they don't, post-firm buildings can go back and show it was built correctly in zone A or built correctly in zone A with the BFE, lower BFE, but it's kind of a pain. Those older buildings, those post-firms can't go back. They have to have coverage in place before the maps change. But again, the policy can be assigned to the new owner. So if you see and hear about a map change, your client doesn't have coverage in place, get them to have coverage in place before the maps change, because then when they sell it, the new owner can get that policy. Because what that does is it locks in that previous zone or that lower BFE for future rating. Doesn't lock in the rate itself, but allows the agent to continue to rate using zone AE or continue to rate using the lower BFE, the base flood elevation. So again, get coverage in place before the maps change, and then you can assign that policy to the new owner. With the details that we now have with data and with our models and a thing called LIDAR, which is plane flying laser over the ground and getting much better detail of the topography and the land, we actually see where the floodplains in areas shrink. And in that case, the house was in a high-risk area, and when the new maps come out, we find that it's in a low-risk area or moderate risk area. And what happens is that the new owner, when the maps become effective, gets a letter from the lender that says, hey, you're no longer required to have flood insurance. So they do the happy dance and they say, yeehaw, look at how much money we're saving. We don't have to pay $2,000 or whatever the number is anymore, because we know the lender says we don't need it. So they misread the letter and they think they're no longer at risk, when in fact they are. It's just the risk has been reduced. So what we do is encourage the insurance agents to get ahead of the game, get the insurance companies to convert that high-risk policy to a preferred risk policy. So if the high-risk policy was $1,400 and the preferred risk policy is $400, they can convert it back to the effective date of that policy, and the owner gets the difference of that $1,000 in my example back. So they do nothing. And the insurance agent is encouraged to do it because they get to keep commission on both dollars. And I know you as realtors understand the importance of commission. And that way they stay protected. The community has one more person that has flood insurance. So next time, when, not if it floods, they recover more quickly, are more resilient. And because the key thing to remember is that risk is only reduced. It has not been removed. And in Louisiana, for those who have had policies, 1 out of 4 claims have occurred in these low, moderate risk areas. So let's make sure in those areas they maintain coverage for sure. So I keep talking about find out where the changes are happening. So I've got in the next couple of slides some resources for your realtors. The slide deck was provided to those who are listening to this now. So I'm going to kind of go through this quickly, but wanted to let you know there are resources so you know what's going on. First and foremost, there's the Flood Map Service Center. There you can get not only what the current effective maps are, but if there's preliminary maps, which I'll show how to use them. There are historic maps if you want to go back and look to say what flood zone was it in. Agents use that for their grandfathering aspect. And you can pop up, print out actually these mini flood maps of the property so you can actually show an insured or, a client, a homeowner, whoever it might be, here is where the property is on the flood map. So you can be proactive to let them know what their flood risk is. You can get these great formats. There's the link there. Go online. Look at how much easier it is to read these online. You could really see the homes. You can see the flood zone, where different flood zones where they are. If you want to find out more details about what different products are out there, you can just on that Map Service Center side bar, click there. You can fill in. Here I filled in Louisiana and Plaquemines Parish, and there you can see at the bottom they've got effective and prelim maps out there. Plus, if I want to take a look back at the older maps, I can do that as well. But let's say that you do have prelims out there and you're wondering, okay, I'm going to be selling or buying property in this area. What has changed? So you can actually pull up a comparison of what today's map looks like compared to what the preliminary, and see, oh my gosh, on the left, that was not in a high risk area, and now it's showing that it is. And I'm showing that, well, the good news is where I have that little dot, I'm at a moderate risk, but not at a high risk area, but I am behind that dash, behind a levee. So there is always that risk that it can be overtop or failed. So yeah, it's probably good to have flood insurance, but it helps you tell your client what your risk is. The explanation of how to use the tool and actual link, which is really long, is at this URL, so please click on that to learn more. A great tool for realtors, again, to know how is the risks changing in the area, and flood insurance requirements will probably change as well for my clients. Want to find out where your parish is or community is in a mapping project? There's that link there. So a lot of good resources for you. And I'm going to stop right there and see if any other questions have popped up. Okay.
No questions have come in so far.
All right. Thanks. Well, I'm going to finish up with this last section before we get into resources, because there seemed to be some interest in it. Austin asked me to also update you all with what I know about Risk Rating 2.0. Interesting enough, I'm out here in California this week to give a presentation on these two topics. I'll be doing private flood, and the FEMA person will be doing Risk Rating 2.0. So a couple days earlier or if we'd done this a couple days later, I might have had a little more update. But I've seen his slides, and I don't really think there's much more to add at this point. So the NFIP has been the ruler for 50 years, basically, of flood insurance. But we've seen a surge since reform legislation and new technology of the private flood insurance. We know that the NFIP is a very complicated and difficult product. You could ask up to 150 questions or so to help rate a risk, though you won't ask them all. There's, I think, about that many different types of questions. When I was first looking at private flood, when I was managing an insurance company's program, flood insurance program, in the late 90s, I found about 10 private programs. Now there are over 50 just in the past 5 years or so that are writing private residential flood insurance, and they're writing them in Louisiana. So we want to just make you a little bit aware of what these are. Two different types of markets or areas. There is one called admitted, and that means they are submitting their rates and their policy for approval with the Department of Insurance there in Louisiana. But because it's catastrophe type of insurance, flood insurance is, because as opposed to fires, actuaries can figure out, and auto accidents and stuff, it's a lot easier to figure out how often those are going to happen. Flood is not. Flood is kind of a cat risk, just like earthquake and others. So there's the non-admitted, which means they can write without having approval from the state for the policy form, the wording, or its rates. But they do not have access to the state guarantee fund, which says if I go belly up as a carrier and I can't pay your claims, you're kind of sad out of luck. Where in the admitted market, the state has a fund to help cover those claims. Hopefully insurance agents explain those to the person before he or she buys a non-admitted policy. But here's what's really driven it. New technology is out there to help determine properties of that building. Is it how far from the coast it is, how elevated it is? Lots of different aspects of the building can now be so easily and quickly determined. So companies are able to quote and gather this information and give a quote on a building without having the agent to fill in all this information. The lender compliance, the law had said you must accept it, lenders, if it is as broad as. So then it came down to who's going to make that decision. Well, now most lenders are accepting private flood. Private flood policies are being smart because they're adding language, and now that if you do add a certain type of language, lenders will accept it. So they're beyond that barrier. And we're seeing things are a lot broader. For example, the limits are being written much higher, up to $5 million or more for buildings. They're including replacement costs on both building and contents, where the NFIP policy has a very specific type of building that it will give replacement costs to. And other than that, you can't get it. Cancellations, you cannot say with the NFIP, I don't want it anymore. But with the private floods, you can. The waiting period of 30 days is not there at all, and we see usually 0 to 5, but we did see some up to 2 weeks. Many of them just say, hey, if there's a storm approaching, a tropical storm, we'll stop writing, but once it's passed, we'll continue to write, and otherwise there's not a waiting period. But here's where we've seen a bunch of differences. Besides the higher limits, we're also seeing they're providing additional living expense, which is like if your house catches on fire and you have to go to a hotel, your homeowners will help cover that hotel cost. That's not available with the NFIP, but we're seeing private flood offering that. We're offering basement. We're offering, here's $10,000. Use as you want to do whatever you need to get back into your house, as well as other coverages. So broader, higher limits, replacement costs, limited or no waiting period, and we're seeing lower costs. And as I mentioned, with the lender requirement, starting July 1st, finally the regulators came out with some rules to help guide the lenders to say, here's how you can accept a private flood policy. So for you realtors, at closing, if they're in a high-risk area, they don't necessarily have to show up with an NFIP policy, but make sure that the lender is okay with the policy in advance, so you don't get there with the private flood and go, oh, we don't accept that, or we don't like that, or we have to make sure it's okay, and that may delay closing or what have you. So I wanted to let you know that private flood is being accepted, and more and more and more. So I think it's here to stay. It's still a very small percentage out there, maybe 3, 4, 5% of all flood policies being written, but look for that to increase. One thing to keep in mind is if you do move as a property owner from the NFIP to a private flood and you try to come back, that will count as a lapse, and certain pre-firm subsidies or newly mapped procedure policies you won't be able to get. So hopefully the lender will be the insurance agent will be telling them that. There is a 30-day waiting period then to come back in, as well as you don't have access in the non-admitted market to the state guarantee fund. So kind of a couple things to be aware of if you do go private flood. Hopefully the insurance agents are saying that. The NFIP is wanting to go kind of the same direction. So they're coming up with Risk Rating 2.0. And with Risk Rating 2.0, they're coming up with a rating system that is going to be so much easier, kind of as I described with the private. So the agents will be able to quote it more quickly. The insureds will understand what the heck they're getting. And the rates will represent more what the risk is. The time and the impact, what are the rates going to look like? Well, the guy I'm going to be presenting with, Tony Akefima, loves to show a blank piece of paper. So we don't know yet. We're still working on it. And hopefully they'll, actually I think this fall they're supposed to be releasing the rates internally to be tested and worked with. But they will be officially released April 1st. They'll be for single family homes nationwide. Initially it was going to be just the coastal East and Gulf Coast areas from North Carolina to Texas. Now they're going to do it nationwide, but it's for single family homes. So the other non-residential and other residential buildings will have to be rated the old way. They'll be released April and they'll become effective October. So that means renewals will start coming out like in August. So stay tuned to see how that may affect your clients and their insurance rates on that. There's some discussion that it'll be based upon replacement costs, which right now they're not. They'll be also included based upon how close they are to the flooding source. So those that might be closer to a river or the ocean may, in the same flood zone, may get a higher rate compared to those who are further away and maybe closer to that low risk zone. Their risk is lower, so therefore you may see their rate actually be lower. So stay tuned. Again, they haven't released it as Tony Hake goes. They're still putting the recipe together to bake this cake, and but hopefully that cake will be out. We'll be able to see the ingredients starting next April. I'm going to skip questions here and just go straight into resources, and then we'll end up with questions at the end. Just wanted to let you know, here's a great resource for you, the realtor, for the consumer about flood insurance. And if you have a website and you're wanting to send somebody about learning more about flood insurance, this Flood Smart website is fabulous. If you want to get a little more, sometimes we find realtors that are agents or insurance agents that are realtors as well. This has more details in there. It also is where you can download the National Flood Insurance Program's Flood Insurance Manual. This is kind of the underwriting Bible, if you will. We do have information for realtors about mapping, and I have that link there at the bottom as well. And there are some very good fact sheets and brochures related specifically to realtors that you may want to consider to have your office, if you have an office of realtors, to have available and down there for people to pick up or to share to help educate people in your office about flood insurance from a realtor's perspective. And we do have some for property owners as well. The one on the left is the preferred risk policy. The one in the center, actually, it's great for you guys as well. It's what I just described in 10 minutes about map changes. This fact sheet covers for you. So it's a great two-pager or one-pager front and back to help explain map changes and what the impacts are. And then more details about what does a policy cover. Even though it's somewhat of a dated document, it's still a very good one that explains at a very simple level what your policy covers. Susan Vaillant is the person who's overseeing this project. She's with the Floodplain Management Program, CTP project manager, the cooperating technical for FEMA. Gil Gilron is the insurance liaison for Region 6. If you've got questions about flood insurance, I can take them as well, but he's the man, as they say, over at FEMA over there in Dallas, the Denton area. Very, very knowledgeable. So that's a quick overview about some flood insurance basics, and also a little bit on map changes so you're aware of how important it is to know what those map changes are, so you can make sure your client knows, hey, it's no longer going to be in a high-risk area, good news, or it's going to be in a high-risk area, so if you're selling that home, let's get flood insurance in place, even though you're not required right now, because then you can transfer that policy over and it can be a cost savings selling. And then the point about pre-firm homes, know how it's going to be used, what flood zone it's in, and when was it built before or after that first flood map. So some key points there. I'll stop, Amy. We've got a few minutes for questions to see if we have any.
There is one that said, can you do an appeal to change flood insurance ratings by levies detaching lower, wait, hold on. Can you do an appeal to change flood insurance rating by levies detaching lower secondary buildings, and where?
Not quite sure I follow, but let me see if I can answer a couple things. So if you're going through a map change and the preliminary maps are released, they will have a 90-day appeal period, as it's called, or public comment period, where you can scientifically show or technically show that the maps used the wrong model, or they used the wrong data, or did something incorrectly. And that's usually a major effort. If the maps become effective, or already are, and the home appears to be built on higher ground than maybe what the maps pick up, because the maps can't get down to the detail that an individual surveyor could go. And I had a slide in here and I took it out at the time. You can get what's called a letter of map amendment, a LOMA, L-O-M-A, and get an elevation certificate to show that the lowest adjacent grade is at or above that base flood elevation. So where the dirt is along the lowest part, dirt around the house, is at or above base flood elevation. You can have that home taken out of the floodplain, and you literally get a letter from FEMA that literally amends the map, and that LOMA is actually put as point on the map. So on the digital maps, you can pull that letter up, and therefore flood insurance just got a lot cheaper. So hopefully that helped answer the question.
Okay, and the other question was, is grandfathering going away?
Amy, I left my crystal ball back at home, sorry. And that's, we don't know. So when the legislation in 2012 came out, known as Biggert-Waters or BW12, they changed grandfathering to that in 5 years, it would go up 20% a year, and it would reach a full risk rate, and therefore you would never be able to grandfather after that. In 2014, with the Homeowner Flood Insurance Affordability Act, Congress said, ooh, and especially the National Association of Realtors had a really strong voice up there to say, hey, you just really hurt a lot of people, the ability to sell homes, et cetera. So in 2014, they took that away, and grandfathering is back the way it always has been, and it still is. I haven't seen anything really in the reform legislation that's out there now, or the reauthorization, that is affecting that. And we don't know with Risk Rating 2.0 how they're going to be handling grandfathering. I've been in several workshops with different audiences, and that question usually comes up every time. And the answer is, we don't know. And I don't think they're ignoring or trying to sidestep the question, because they're still, as I said, building the cake and the recipe, that they really don't know how they're going to address it yet. So we'll have to stay tuned to April to see what they do.
Okay, at this time, are there any other questions that you have? Bruce, thank you so much. There's so much good information in there. I picked up a few good resources that we need to add over to our disaster resources page on our website. and certainly we'll make this available there as well, so that realtors can ask questions or find out more about what are the things that they need to be considering when working with their clients.
Awesome. Well, thank you for the opportunity. Thank you very much for giving Louisiana Department of Transportation Development to share this information with you.
Have a good day, everyone.
All right. Bye now.
Bye, Bruce. Thank you.